Hello and welcome to part 5 of Property Profits Real Estate Business Building, where we help you grow a real estate business, not just a portfolio. My name is Gord Lemon and I've been involved in Canadian and US real estate for over 26 years. I've also helped many people build their real estate businesses as a real estate entrepreneur coach and speaker, and I'm also a published author with many real estate articles in various publications. As this video does contain information which may be content and time sensitive, it's important that you pause the video and read this disclaimer prior to moving on. In this video, we're going to discuss the privileges that a lender gives us when we have a mortgage, as well as the penalties involved when we want to break that mortgage. So what do I mean by privilege when referring to mortgages? Is it a privilege to pay a mortgage payment? Well, some could argue that in this country, it is amazing that our banks would lend us up to 95% of the value of a property so we can live in it, or up to 80% on a property we can actually make money on and gain equity in through our tenants paying the mortgage off. But that's not the privilege I'm speaking of here. I'm speaking of prepayment privileges. If you own a property today and you're not sure what your prepayment privileges are, check what is called your standard charge terms. Now, this is a document which your lender has given you, which you signed, by the way, which outlines all the pertinent factors you have agreed to as a mortgage holder. One of these areas will outline your prepayment privileges. Another area will outline the penalties involved if you decide to break that mortgage. Let's discuss these now. So, prepayment privileges. Depending on the lender, the options can be either paying 15, 20, or even up to 25%, depending on the lender, of your regular monthly mortgage payment. So this is an extra payment that you can put on every month that goes right against the principal. And then you can do a lump sum of either 15, 20, or 25%, depending on the lender, of the original mortgage amount once a year. Some lenders let you do this throughout the year anyway, so check into that with your own lender. Again, these percentage amounts depend on the lender and the type of mortgage product that you have. It's important to discuss the terms of the mortgage because it is the terms you're choosing which can determine the severity of your penalty. So the term of a variable rate mortgage is usually 5 years, which can either be open or closed. An open mortgage means you can get out at any time with no penalty, although the rate will be a little higher for that privilege. And a closed term means you're locked in for 5 years. However, in a variable rate mortgage, a 3-month interest penalty will kick in if you choose to break that mortgage. Variable rate mortgages also allow you the capability to jump into a fixed mortgage whenever you choose. Now, with a fixed mortgage, you can choose a term of 1, 2, 3, 4, 5, 7, or 10 years. The longer the term you choose, the more you're hedging against any interest rate risk or fluctuation. The cool thing with a 10-year mortgage is once you've hit the 6th year, in other words, the day after the 5th year, the mortgage can be broken with only a 3-month interest penalty. So let's talk more penalties. So either you're paying out the mortgage early because you won the lottery or came into a lump sum of money and you want to target the mortgage right away and pay it off. Or perhaps you're moving to another part of the country and having to get another mortgage, or just moving to another lender because the rates have dropped and you're wanting to take advantage of that. And that's usually the most common reason. So the penalty for paying out a variable rate mortgage, like I said, is typically a 3-month interest penalty. And so that means you're paying the interest on 3 months of your regular mortgage payments, the interest portion. Now, breaking a fixed rate mortgage triggers a calculation known as an interest rate differential. The interest rate differential, or IRD, is calculated as the balance owing times the difference between the prevailing rate and the current rate you already have on your mortgage, multiplied by the time left remaining. So let's do a quick calculation. In this example, you initially got a fixed rate mortgage at 4.59% with a 5-year term. It so happens that at the end of year 3, rates have dropped to 3.19, and you're wondering whether it's worth getting out of this current mortgage in order to save money, even if you have a penalty to pay. You can do this calculation on your own mortgage to see whether you'll be ahead of the game at the end of the day. So for this example, for ease of numbers, you have a $300,000 mortgage balance remaining on the mortgage with exactly 2 years left in a 5-year term. So we'll be subtracting the prevailing rate of 3.19 from the rate you currently have, which is 4.59, and that gives us 1.4%. Now we multiply 300,000 times 1.4% times the 2 years that's left on the term, and that gives us an $8,400 penalty as the interest rate differential penalty to get out of the mortgage. So that's all the time we have for now. Do that calculation for yourself and see whether it makes sense for you to make the switch. Join us for the next video in this series. Lots more tips and strategies at www.canadianrejvclub.com or www.PropertyProphets.ca. And don't forget to like us on Facebook. Thanks, take care, we'll see you next time. Bye-bye.